All right, well, thank you, Fiona, and thank you, Chris. As mentioned, and as I was kindly introduced, my name is Andrew Schwam. I am an account manager with Genworth Financial Canada. My job is I work very closely with Alterna, and I share with them product updates and also work with them on getting their mortgages approved. So happy to be here today and share with you how we take part in the rental property and secondary home market space. So our agenda here, as you can see on the screen, I'm going to talk about the government rules and how that's impacted ourselves as a mortgage insurer and how we participate in the rental property market. I'm going to talk a little bit about insured versus conventional mortgages and share with you the difference between those. And lastly, talk about a couple products aside from rental properties that would be a property other than your primary residence. So about Genworth, I would ask how many of you are familiar with Genworth, and usually I get a great response with that. But for those who may not be familiar with Genworth, I do always share that we are direct competitors to CMHC. So we are mortgage insurers. That is our business here in Canada, but as you can see on the screen, we do have a global presence. So we're in 25 different countries. What that's allowed us to do is gather a lot of market information, look at a bunch of different economies, and develop products that would help each of you get into a home. You can see there also, and I mentioned just a few seconds ago, that we are mortgage insurers. So where we stand in the home buying process is you would work with a mortgage professional at Alterna, and if the loan to value on that mortgage is greater than 80%, so meaning you have less than 20% down payment, they will send the mortgage application to Genworth for insurance. So high ratio is 80% and above, and conventional, or also termed as low ratio, is less than 80%. So that's where we play and how we partner with Alterna. And lastly, you'll see on here for the investors that are on the call, we are a public company. You can see our ticker symbol there, and we've done very well if you'd like to check us out. So getting back to rental properties and how Genworth works with them and in the secondary property market, you can see the government mortgage rule change that I've posted here. It was effective April of 2010. And basically what the government had said was anybody looking to purchase a rental or investment property, they must have 20% down payment. And that 20% down payment must come from their own saved resources. So with that being said, and how I shared with you how we work with Alterna, that we insure any properties greater than 80% loan to value, you can kind of put together and see that Genworth effectively, as well as all the other mortgage insurers, have been taken out of the rental property market. So again, we deal with 80% loan to value and higher, where the government changes have made it that rental properties are less than 80% loan to value. That being said, I have some very good information for you on how we do consider some things with rental properties and secondary homes. And I'll start off by sharing a few products that we do have. So this is a secondary home product. And again, because of the government regulations, we do not work with the rental properties. But we have secondary home. We'll allow up to 2 units under this product. And as it applies to vacation properties, we have 2 types of vacation properties. We have vacation properties type A and type B. And a type A vacation property would essentially be a home that you would live in year-round, but it's just in a sort of vacation destination. So the home would have a central heating source, have drinkable water, have year-round access, fully winterized, washroom facilities within the property. And conversely, a type B property would be lacking one of those key features. So it may be only seasonal access, or it does not have a central heating source. We still will consider them, but it's a type B property. There are some differences with that, but just to give you an idea of how we work with vacation properties. Unfortunately, it does not apply for self-employed borrowers, so any secondary home, it must be confirmable income. And you can see the last point on here as it applies to type A properties. You can purchase a secondary home up to 95% loan to value. So that would be for secondary type A. A secondary type B would be 90% loan to value. So if you are looking to purchase a secondary home, the biggest recommendation I would give is just to work with somebody at Alterna and see what the options are and the down payment requirements. So speaking to the 95% loan to value and secondary homes, we do have another product, and it's called the family plan. And on the family plan, the maximum loan to value as well is 95% loan to value. It's maximum 2 units, where 1 unit must be owner occupied by a direct family member. So an example of this, and you'll see on the slide as well, would be a parent purchasing a home for their child who would be in college or university, or conversely an adult who's buying a home for an elderly parent who may be on fixed income. So this again is up to 95% loan to value, and it would be where, again, that second unit or one of the 2 units is going to be occupied by the direct family member, and that direct family member who's residing in this secondary home would also go on title of the mortgage. So another great opportunity to purchase a secondary home. Again, it's not a rental property. It can go up to 95% loan to value. Now, I wanted to also share just a little bit of information on how we consider rental income and how we use this to qualify for a mortgage. So when using rental income on a mortgage application, if you're using it from one of the basement suites in your primary residence, so this is your main home, but you have a rental suite in the basement. If you're applying for a mortgage, you can use 50% of the rental income. If you're using on a mortgage application rental income from a property other than your primary residence, then what Alterna will do is they will complete a net rents calculation. And what they will then do is if that works out to a surplus, they will add that to your income. If that net rents calculation works out to a deficit, then they put that as a monthly payment. In both instances, they remove the mortgage from the servicing. So just to give a little bit of information, if you are in the rental space and could be impacted with rental income, just wanted to share that with you. I know at the end of the presentation we have some contact information. If you have any questions, you can definitely reach out to myself or one of the other speakers on the call. And lastly, one thing I wanted to share with you, it's a key differentiator for Genworth, is anytime you have a Genworth insured mortgage, you are eligible to take advantage of our Homebuyer Privileges. And what the Homebuyer Privileges are is a series of discounts with, as you can see on the screen here, a bunch of different national brands, Bell TV, Dell Computer, there's moving companies, vacation companies, hotel groups. So lots of good savings, free to yourselves for up to 2 years. And certainly you can get that information from us as well. So that concludes my portion. I'm going to turn it back over to Fiona.
Thanks, Andrew. Once again, I am Fiona, and I'm going to speak to you on a couple of mortgage options. Here at Alterna, we have a 5-year fixed rate mortgage. This is where your mortgage payment is fixed for just that 5 years. So your rate doesn't change, and neither does your payment. The term is closed, but it does have prepayment options available to you. So you're wondering, why should I choose the 5-year fixed mortgage rate? Well, it's got a consistent monthly payment, so it lets you work within your budget. You know how much this mortgage payment is going to be each month. There's no surprises if the interest rate changes. You already have this set for 5 years. It's a locked-in low mortgage rate, and if you don't intend on selling the property within the next 5 years, then the 5-year rate it stays fixed. Again, you have your prepayment options. It allows you to pay off your debt sooner, which can translate into savings. This means you're paying less interest, so the more money is going to go to your principal, and you'll pay your mortgage off quicker. The other alternative to is a fixed rate is we have our variable rate. We have a closed variable rate, a 3 and a 5 year term. Again, it has your prepayment options. At any time during these, so you can call in and have it fixed to the 5 year rate or even a 3 year rate. So if you find that with your variable rate, the rates are going up, and you decide you want to take advantage of a fixed rate, you can just give us a call. So again, why choose a variable rate mortgage? Well, given the high housing prices in the GTA, your Toronto area, and your National Capital Region area in Ottawa, a small percentage in interest rate reduction, coupled with extended amortization, can translate into more affordable payments. So if you can take advantage of a low rate on the longer term, make it more affordable for your monthly cash flow. Best of both worlds, allowing you to take advantage of the low prime lending rates while also providing the protection of the convertible option should the prime rate go up. We hope that this presentation has given you some insight into the process of mortgages and purchasing properties, rental properties. I want to thank you. If you have any questions, please feel free to contact us at education@alterna.ca.